Well, hello and welcome to Living Healthy 24. This is author Prashanjit Gupta, motivator, speaker, and business boompreneur. Well, today we have got a very special guest in our studio, that is Mr. Soumyajit Ghosh. He is the founder and director of Wealth App Solution Private Limited. His latest assignment was with Citigroup, where he was Director Wealth Management. Let's welcome Mr. Soumyajit Ghosh and let us understand many questions on mutual fund, what exactly mutual funds are and how to invest, when to invest, and lots of queries are there. So let's welcome Mr. Soumyajit Ghosh. So most welcome, Mr. Soumyajit, in our show, Living Healthy 24.
Yeah, thank you so much.
So first thing first, what is mutual fund?
Yeah. So, as the name suggests, mutual fund is when a fund is created by a group of investors with mutual investment objective. So, if 100 investors would like to invest their money in bank fixed deposits, today each one of them go separately to a bank and buy their own fixed deposits. But if 100 of them come together and pool their money and make a large fund, and that fund then goes to a bank for a fixed deposit, you can understand that that fund will have an ability to get 1% higher return because of the size of the fund. So that is how a mutual fund globally is operated, where pool of investors come together with a common objective and they decide to invest their money together. So sometimes you find mutual funds are having different fund objectives. Like all investors do not want to invest in the same investment. Some would like to have bank fixed deposit, some might want to invest in the share market. Similarly, in mutual funds, you have different funds, and investors can come and choose the fund that they would like their money to be invested in. Net net, whichever fund they choose, at the end of the day, the fund invests in the investment objective of the investor and tries to make best returns for the investor. So if an investor individually is going to a bank and getting 6% return, if 1,000 investors come together and go to the same bank, the pool of money, the large sum, say it will create 1,000 crores, and then the 1,000 crore can squeeze 1% more from the bank. So this is the job of a mutual fund. It sort of then gets this 1% more return and distributes equally amongst the investors of the mutual fund. In the mutual fund parlance, they are called unit holders.
Okay, sounds great. So, Mr. Soumyajit, just tell us what is KYC and how to get KYC verified for mutual fund investments.
Very good question. In fact, KYC is called Know Your Customer. So, whenever you are buying or you think of buying a mutual fund, the first thing you have to do is to go to your a bank or a mutual fund agent, or you can even go to a mutual funds office directly and get your KYC checked. KYC check process is similar to the way banks check your KYC before opening a bank account. In mutual fund, they will take your PAN card, your address proof, which is your Aadhaar card, and one piece of photographs with which your KYC can be completed. Now you are ready to invest in mutual funds.
All right, superb. So now, Mr. Soumyajit, the next question is that what is net asset value (NAV) of a scheme?
Okay, so when you invest in a mutual fund, you buy the units of that mutual fund at a particular price. And when you sell, you get a higher price. And that is how you make money in a mutual fund. So if, as I was introducing to you, a mutual fund which invests in bank fixed deposit kind of products. So there, if you want to invest, you can go and see that there are several funds which are non-equity linked mutual funds. So they are called debt funds. They invest in fixed income or bank fixed deposit kind of products. So if you want to buy the product, you will see there is a daily price of that particular fund. Say the NAV of the fund is 10 rupees 20 paisa. So you will have to buy the fund with that price of 10 rupees 20 paisa, and then after 3 months, 6 months, 1 year, 2 year, the NAV will keep increasing to 11 rupees or 12 rupees. So when you sell, you get back 12 rupees. So the real gain that you get is the difference between 12 rupees and 10 rupees 20 paisa, and that is your gain from the mutual fund investment.
Okay. What is expense ratio?
Okay, expense ratio is the ratio at which a mutual fund charges to manage your money. So as you know, in this case, your mutual funds are managing your money, and they need some money to manage their day-to-day office and their management team. So for every mutual fund, there is a separate expense ratio, and as an investor, you should know that when you are investing 100 rupees, the expense ratio of the mutual fund varies somewhere between 0.5% to 1.5 or 2%. So this is what is the expense of buying a mutual fund. It gets adjusted with into your NAV. So you can't see what is the expense that you are paying to the mutual fund house. Your NAVs are declared taking the entire expense into account.
Okay, so a person who's purchasing the mutual fund, they need to give 0.5% in 100 rupees, right? So they need to give this amount in selling also, or just in purchasing?
Very good question. In fact, the expense is adjusted from up before calculating the NAV. So as I said, the client will not come to know what is the expense. He will see that if I buy the fund today, the NAV is 10 rupees 20 paisa, and the day he sells, he can see the NAV on the website or on the newspaper. The NAV is 12 rupees, so he sells the fund at 12 rupees. So, and he gets the difference. He can't understand what has been the expense that the mutual fund has charged him while he stayed invested in the fund.
Okay.
If he wants to know what has been his expense, the distributor or the bank through whom he is buying the mutual fund, he should tell him that if you buy this product has 0.5% expense, this product has 1% expense, and basis the performance of the fund as well as the expense, a distributor or a bank should ideally suggest a good fund to the client.
Okay. What is load on or no load fund?
Yeah. So these mutual funds that generally people buy are called open-ended or open mutual funds. So you can come in or come out of the fund anytime. But sometimes some funds have an exit load. So that you cannot, you cannot come in and come out of the fund frequently. So while entering a fund, if you pay any load, is called entry load. In India, there is no fund with an entry load. So you can freely buy your mutual fund in India without any entry load. But certain funds put an exit load, and they are called back-ended load if you do not stay in the fund for a desired period. So say you have bought a fund for 1 year, and the exit load is charged only if you come out of the fund before 1 year. In most of the equity driven funds, there are exit loads of 1% before 1 year. And similarly, if the fund is not investing in share market, then there is generally no exit load for any customer. But it is advisable to ask your distributor or your bank what is the exit load of a fund before investing in the fund. You need not ask and bother about entry load. As I said, in India, there is no entry load to enter any mutual fund.
All right. What is SIP?
Ah, excellent. You have asked the most loved question of the country. SIP is systematic investment plan. I have over the last 20-25 years that I have been selling or I've been advising my clients to buy mutual funds. I have never seen so much of interest as I see nowadays for young people, for investors to buy SIPs. So SIP is nothing but a process of buying mutual fund in a systematic manner. So in common and very common way, you can say these are like recurring deposits. Just like in a bank, you go and buy a recurring deposit. Everybody knows what is a recurring deposit. In mutual fund, you can buy the mutual fund in a recurring way. It is absolutely aptly suited for salaried people. So if salaried people are earning or are saving, say, 2000 rupees a month, they can go to a mutual fund and say, okay, I want to invest 2000 rupees a month in the SIP route or systematic investment plan route. So the process is set that automatically from his bank account 2000 rupees is deducted and is invested into the mutual fund. Once he signs a piece of paper, he doesn't have to give any post-dated check or anything like that. It sort of sets like an ECS and it automatically debits his account and invests the money as desired by him, say 1000, 2000 or 5000 rupees every month. Now, in case of equity market, as you know, share market is very volatile. Markets are going up, markets are going down. So if somebody wants to enter the share market, SIP works as the best investment avenue that you invest a fixed amount every month and that fixed amount sort of buys into the market. Whether the markets are high or low, it doesn't matter. It will systematically invest your money in the market. So you will average out on this volatility of the market. And in a process, in the long run, you make higher returns than any other return that you can get from any conventional investment. Just to add, over the last 10 or 20 years, if a client would have invested in the worst performing equity mutual fund in the SIP route, even then he would have got more than 10% return. And 10% sort of post-tax return in a country like India, and I'm talking about compounded return. So it's fantastic. So as you know, there is a very simple rule that we use to talk to our clients that if you invest every month 10,000 rupees and if the 10,000 rupees grows at the rate of 10% for 10 years, how much will the money be? And once you calculate returns at 10%, you will be surprised to see that you can really create a very large corpus in a systematic route.
What is the minimum duration for this SIPs and all?
So SIP is a solution kind of a approach. So if your son or daughter is say 5 years old and you think that you are saving when the daughter or son will become 18, so ideally you should choose a SIP to do for the next 13 years and try to save some amount every month so that over 13 years you can create a corpus.
Okay, superb. So the viewers, the message is that SIP should be a long term because it will give you a much more benefit in the long term, right? As Mr. Soumyajit has mentioned that if you have got a child of 5 years and you are thinking to have some good amount for their studies or whatever their marriage and all, so you can do the SIP keeping that point in your mind as a goal, and definitely at the time of their marriage or for the high studies you will get a good amount of money according to the 10%. All right.
Some mutual funds also give a free life insurance cover in case when a father is saving for the child and for some unforeseen reason if the father dies in that period of 15 years or 13 years, the mutual fund will pay the family a lump sum money. So this insurance protection cover comes free for the family from certain mutual funds. So when you buy a SIP, especially young parents, please talk to your bank or for your to your distributor about SIP Insure. The product or the solution is called SIP Insure. As you all know, there are also good products which are called ULIPs. They are available from the life insurance side of the companies. But when you buy SIP, you can also get free life insurance cover. And in my understanding, I have seen that SIP Insure comes very cheap to the client. Life insurance cover, some products are also good, but generally when I compare these two solutions, I find that the SIP Insure comes at a gives a better return with a cheaper cost because life insurance cover comes free. Around 4 or 5 mutual funds in India provide this facility. So when you are looking at taking a solution kind of a approach for your child's higher education, especially, you can take a look at the SIP Insure product.
Wow, this is fantastic. That this is really a very new and great one that about the theft insurance. But remember, every mutual fund is not offering. Some of the companies are offering. So definitely talk to your bankers about this shift insurance.